Let's check the broader markets now as earnings continue to push markets higher, especially the Dow yesterday. Nearly closed at a record high. I think all the other averages did. Joining us now is Michael Tyler. He's Chief Investment Officer at Eastern Bank Wealth Management, along with Matt Toms, who's Chief Investment Officer of Fixed Income at Voya Investment Management. They've got $134 billion in fixed income assets. So welcome to you both. And let's just begin with you, Matt. Fixed income, bond yields, that has felt like it's not at all the story this year. We're focused so much on equity prices. What do you expect out of the Fed today?
We're calling this the Jersey Shore version of the Fed meeting. So it's on autopilot. We expect the setup for the balance sheet reduction in September. And then the decision we're all waiting for is in December if they hike one more time. We believe they ultimately will, but very few surprises expected today.
Wait, what was the Jersey Shore reference?
I don't think it's a pejorative. I think you're just saying people are on vacation because I think Snooki and those other idiots that were on that's not what you're talking about, right? You just mean they're on vacation.
Not trying to denigrate the Fed, trying to say there's a more relaxed tone about the market.
You're not denigrating New Jersey. Let's be clear. You're not
not at all. It's a beautiful time to be at the beach.
Beautiful. The shore is beautiful. Look, there's some spots that are a little iffy, but in general, I mean, it's. I mean, Andrew's not going to the Jersey Shore anytime soon. But you go east, young man, right?
I like Jersey.
You go east.
Michael, do you want to make a Hamptons reference to the stock market?
Yeah.
Or how does this all
keep it
come
fair
down for you?
No, I'm not that creative. You know, the stock market's on autopilot too. As long as the earnings keep coming in, and we're halfway through a very good earnings period right now, and we're looking at another fairly good second half of the year. Maybe not as torrid as the first half. You know, maybe we'll slow down from the 12% of the first quarter and maybe get 8 or 9% earnings growth the rest of the year. But that's still pretty good, and that's enough to keep the stock market afloat.
Yeah, Michael, I read the other day.
My beach reference.
Yeah, I guess I hadn't quite realized that the S&P earnings had been stuck around $118 for the last maybe 2 or 3 years now, and all of a sudden we're talking about the 120s this year and the 130s next year. Is that right?
Yeah, that's exactly right.
What's driving all that?
I think what's driving it is a couple things. One is that the underlying consumer demand continues to be pretty strong, and we are finally seeing a resumption in durable goods, capital goods orders coming in. Those two together help. And, you know, the other thing that's really a big thing that people aren't talking about much is that the dollar's down about 8% this year against most other currencies.
Yeah.
That's really powerful. Europe is reviving. The weaker dollar is helping U.S. exports. But the other thing that's really cool is that the weaker dollar is also causing some import price inflation. And if that can get passed through to consumers, then we might actually see a wee bit more inflation. That kind of pricing power is good for earnings, and it's also good for GDP growth.
But, Matt, we want the kind of inflation that means wages are going up, too, right? We don't want people losing their real spending power. It's this idea that the whole price level increases. And is the wage piece there?
The wage piece is there increasingly at the lower end, and that's key. The lower income segment is gaining momentum. We think that's key to the sustainability of the recovery, and I completely agree that the weaker dollar, stronger earnings lets that continue, and that's ultimately the path to a higher growth rate and a higher inflation rate. It's very constructive news longer term.
Matt, what about the dollar, though? I mean, can yields, you know, let's take the 10-year, I think it's around 2.3%. Can that go higher on this positive story you're telling, or does the dollar keep a lid on it?
The dollar had to not strengthen. So we've seen the dollar in a channel for 2 years. The dollar is the speed limiter to the Fed hike pace. And we think the recent decline of 6 to 8% this year regarding which way you look at the dollar is very constructive, allows the Fed now to step back into balance sheet mode, which will be the priority, because they'll tie balance sheet to financial stability. That's the next step, is get that balance sheet down. One non-consensus view we have is that they might actually have to accelerate that balance sheet runoff. Very slow pace anticipated right now. That might actually be sped up in 2018, 2019.
Michael, real quickly then, the last time that Janet Yellen spoke, she seemed to back off a little bit and say, you know, maybe there is something more to this low inflation, and we saw a positive response in equity markets. If the scenario you guys are talking about means they're a little bit, I'll say, more hawkish on inflation this afternoon, does that spark a market sell-off?
The only thing that would spark a market sell-off is if she's so hawkish that people worry about inverting the yield curve. So we really do have to look for what's happening with long-term interest rates. And, you know, that's why they want to roll off the balance sheet. They want to affect long-term rates. But the way they're doing it is going to be too slow to make a difference. And so I agree with Matt. They are going to have to speed that up.
There's the 10-year, 2.316% this morning. We'll see what happens throughout the day. Gentlemen, thank you both. Matt Toms and Michael Tyler.
All right.